Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known by many of you as Mr. Valuation. I want to welcome you to part 2 of my 3-part series on dissecting the Dow, where in each part I will look at 10 of the Dow stocks. In part 1, I looked at the 10 Dow stocks that I felt were most reasonably valued of the 30. In fact, it's important to point out, I think, that I found only 10 out of the 30 that were fairly valued. That's a good indication of kind of the overall overvaluation or high valuation of the market if you are willing to consider the Dow Jones Industrial Average 30 stocks representative of the market. So in this part 2, I'm going to look at 10 middle stocks. These would be the least overvalued relative to the final 10 that I'll cover in part 3. But on the other hand, you're going to see most of these stocks are really pretty pricey. So I'm going to also go through these stocks and illustrate, like I always like to say, it's a market of stocks, not a stock market, and illustrate how different these companies are. And again, these companies represent the stock market. So let's go ahead and get started by looking at a portfolio review of the second intermediate Dow stocks that I created. I call it Dow 2 under the FastGraphs portfolio review, we call it. And I've set several columns up here, extremely important columns relative to evaluating stocks. First of all, I think if you just look at the credit ratings of these 10 stocks, you see that they're clearly, this is a very, very high quality group, even higher than the first 10 where you had some better valuations. All right. So, they range from the lowest is American Express at BBB+, which is one step away from A. The rest of them are either A, AA, A+, and then of course we do have the AAA rated Johnson & Johnson in this group. I've organized this initially by PE ratio and earnings yield. Those are the important factors here. I like to see an earnings yield of 6.5% to 7%. And I want to explain this again because I just don't think people get the idea of earnings yield. Earnings yield to me is the most important valuation metric. I consider it the essence of valuation because it tells you that if you owned 100% of the company and were entitled to 100% of their profits, all the profits the company had, what would your yield on your investment be if you bought that whole company today, in other words? And what you're looking at are companies here with earnings yields ranging from 5.79%, which is getting close to the 6.5 to 7 with Cisco, going all the way down to about half with Coca-Cola, about 3.7%. All right. In other words, that means that that's the total return that all the profitability of these companies are generating on your behalf. I want you to think of that from a perspective of, are you willing to take the risk of owning a stock with the opportunity to only have that kind of yield if you, like me, recognize that when you buy a stock, you're investing in the business, and ultimately it's the business results that generate value. So I'm going to go through these one at a time, and I'm going to go through them very quickly. But again, I have a secondary objective here, is I want you to see just how different these companies are. They have different growth rates, different histories, different consistencies of growth, different dividend records, etc. Now, one thing that's interesting, all of these stocks do pay a dividend. All right. So that's, something, and I've actually got an error here. I meant to put dividend yield and I put dividend rate. So let me correct that here. And I can do it very easily just by hitting the drop down window here. And now I've got the dividend yield. So all of these stocks offer a dividend yield. The lowest is American Express. Now I can organize this by the lowest to highest. You've got UnitedHealth here at 1.4 all the way up to 3M at a 3% yield. And these yields are important if you're a dividend growth investor especially. But I'm going to keep the order here as earnings yield like I originally did. And I'm going to go through these stocks one at a time so you can kind of see what the relative valuation is. So with the first company, I'm going to look at Cisco. Now, what's interesting about Cisco, the earnings yield here is 5.79%. That's very, very close to the 6.5 to 7% that I consider a minimum threshold. And by the way, I don't consider 6.5 to 7 ideal. I consider it, the minimum. If the company's profits don't represent at least that much return to me as an investor, why would I bother taking the risk of investing in them? But anyway, Cisco's trading at a blended PE of 17. The orange line on this graph is a PE of 15. And on this graph, I'm showing a normal PE of 19. But I want you to understand something about this blue line. This is simply a trimmed average over the time frame being measured. And what you're including in there is this huge overvaluation we had during the tech bubble, which ended in, the summer and fall of 2000, depending on the company. In Cisco, it peaked in August of 2000, and then you saw this incredible drop in value. So that's what can happen with valuation. But now we've got a PE of 17. Now, you can see even here where you had PEs in that range, this is pretty close at 18.08, just about one, percentage point higher. You can see that can lead to, long periods of time, 3-4 years of extended underperformance. But I also want you to notice something else here. When you're using this tool, it's dynamic. And that's, to me, the greatest benefit of the fast graph research tool. So when I get rid of these high valuations where I'm measuring PEs of 100 and plus into here, when I shorten this time frame to 15 years, now all of a sudden I get a totally different perspective. The normal PE ratio now for Cisco has been about 13. So now clearly a 17 PE ratio is significantly higher than the normal 17. And you can see for all these years coming out of the Great Recession that we had PEs of 11 and 12. And, and then of course we did have a period where the PEs got high, similar to what they are now, where, 16 and 17 times earnings, which led to, the stock value moving back into alignment with fair value, if you will, or intrinsic value, which is the orange line. I do believe Cisco's worthy of trading on this orange line, but I also know just by looking at this graph that there's been a long period of history here where it's traded at a discount. And this is a premier tech stock, AA rated with only 19% debt. I do want you to notice the earnings growth is about 5.6% here, but I also include a negative year coming out of the Great Recession. So if I chop one more year off of that, now my growth rate runs up to 7% and my PE stays around 13. These are reference lines. These are things that you look at and evaluate how the pricing has been historically. And you can see that this current valuation on Cisco is extremely high relative to the last decade or so. If I go into the forecasting calculator, analysts are expecting growth of about 3.5% going forward, which to me really beguiles the idea that why is it trading at a premium valuation when its forecast growth is expected to be lower than its recent historical growth? That should be another red flag for you. So I can also then look at the longer term trend line growth, and it's only expected to be 4%. Even if I blend the two together, if I, look at the near-term estimates for the next couple of years and then grow them at the trend line longer-term expectation of 4%, Cisco does not look like a great investment from these levels. I do want to make that clear. However, when you had an opportunity to buy Cisco at these lower PEs, like here you could have bought it at a 10 PE, then that turned this slower, relatively, I'll call it moderate growing investment into a 15% rate of return. As I always say, valuation matters, and it matters a lot. The point is, I believe by just studying this graph that if I'm patient, I'll probably get an opportunity to buy Cisco again when I do have a margin of safety like I do when the price is below even the blue line on this graph. All right, so Cisco looks moderately overvalued to me. The next one would be Johnson & Johnson, AAA Johnson & Johnson, currently trading at a 19 blended PE ratio, which is on the high side. Its normal PE for this long-term period here, going back to 2001, has been about 17. But then again, if I run these shorter time frames, you can see that the normal PE here has been somewhere between 15 and 16 times earnings. The stock currently at 9 times earnings is pricing. Now, what does that really mean? Well, if I bought the stock when it was inexpensive like this coming out of the Great Recession, I ended up making about 10.5%. Now, I underperformed the market on capital appreciation, the overall market, if using the S&P as my proxy for the market, but I got significantly more income, but I also have one of the highest quality companies on the planet. But the point is, that's when I bought it when the valuation was attractive. Now, if I go back in time and look for a time when I'd have bought it at around a 19 PE, which would have been right here. This is real close to what the PE is currently here. I've got 19.21 versus 19.29. My long-term rate of return ends up being just under 8%. Now, I'm participating in the growth of the company, but again, I've missed out on growth plus the dividend income. The key is you want to buy stocks when they're trading in a margin of safety. Great company. I do believe if history's any guide, I'll get my chance to buy Johnson & Johnson again in the future at a reasonable price. By the way, I own Johnson & Johnson, and I was accumulating it for clients back in here. I'm continuing to hold it. I don't think it's anywhere near a sell. I just don't think it's a good entry point for the stock. Now, I also want to make that point clear. Going on, 3M. Now, 3M is very interesting because here we're starting to get into, just as we saw with Johnson & Johnson, a stock that tends to have a premium valuation, for the brand possibly. If you want to own this stock, you sometimes have to be willing to pay up. But again, if I shorten the time frame, the normal PE drops down to about 18. But again, that's just a measuring stick. That number doesn't mean 18 is the right number. It simply means there it is drawn on the graph. And there were a lot of times where you could have bought it coming out of the Great Recession at a lower PE, and a lot of times when the PE was higher. But that's been what the market has averaged it out. The times when the PE was higher, times when the PE was lower. But you also see here where you had plenty of opportunity to buy the stock at a 15 PE, originally coming out of the Great Recession. And then very recently, when we had a couple of down years of earnings, you saw the stock get very, very close here with a 15 PE. And of course, now it's rallied above that. Love 3M, love Johnson & Johnson, love Cisco. Actually own all three of them in various portfolios, but I'm not buying them today. If a new client came to me today with money, I wouldn't be buying any of these three, but I still don't plan on selling them because even though their valuations are high, they're not dangerously high. But we saw what happened when 3M's valuation did get dangerously high. That led to just a pretty swift, let me run this calculation for you. That led to a pretty swift, 45% drop in value. And that's a drop that a lot of people struggle with, by the way. And that's my experience with, dealing with investors for 50 years now. Going to UnitedHealth Group, very classic picture here where you have very strong earnings growth averaging 18% a year. Historically, you can see that this is using the P equals growth rate formula. So both the orange line and the blue line are almost, identical here, 17.75 and 18.1, but you've got about an 18 multiple as a reasonable multiple for this stock over the long run. It currently trades at 23 times earnings. Earnings yield's only 4.23%. It is an extremely high quality company, and it has a tremendous long-term track record. It has trounced the S&P 500 in every category historically. Now, I do want to mention that some of that can be attributed to the fact that the price is overvalued right now, but so is the market. Keep that in mind. But here you had a chance to buy it at a moderately expensive PE. The PE was around 26. I shortened time frames here, and I now catch the stock when it was trading at a very low PE ratio coming out of the Great Recession, and my rate of return balloons up to over 24% on capital gain, and add in dividends 25%. Once again, I've got tremendous dividend growth here because this is more of a growth stock. But right now, the stock is extremely expensive, in my opinion, at a PE of 23. It is expected to continue to grow at double-digit rates. The long-term trend line growth is double-digit rates, but this is not a great time to be buying the stock. But anytime you could buy it at or below this orange line, it would be reasonable. And of course, below the orange line would give you the added margin of safety that I think is so important for investors to try to, incorporate in their investing. Caterpillar is a very cyclical company, but it does have a great long-term dividend record. But you could see the price does react to earnings over time. We see Caterpillar looking like it's starting to come down back towards its intrinsic value line. It is pricey today. The earnings yield's only 4%. The dividend yield is 2.1%, and the company does have an extremely stellar dividend record. I want to make that clear. They've paid significantly more income than if you invested, let's say, in an index since 2001. You'd have got a lot more dividend income, and you'd have got a lot more capital gain investing in Caterpillar over time. But again, it's all relative to the valuation you pay. If you buy the stock, when the valuation is higher, your performance may not be quite as good. Now, we still are beating the S&P here on income and almost tying it, where we end up with about a dead heat here over the 14 years. But I want you to note it's a higher valuation measured to a higher valuation, but you also had a period of time where the stock reacted to its earnings results, even though the dividend continued to increase. Note that the payout ratio of the dividend got very, very high in 2016 when earnings were dropping, but yet the company continued to raise their dividend through that time frame. Anyway, that's what Caterpillar looks like today. Here's Procter & Gamble, perennially overvalued. This stock is, double A minus rated, 27% debt. It's a stalwart, staple, household products company. People use it every day. It's got about a 6.5% long-term growth rate. The market likes to price this at a premium valuation. Very, very rare that you have an opportunity to buy this at an earnings yield of 6.5% to 7%. I do want to make that clear. But when you pay these high multiples to buy the stock, even if we pay a 20 multiple here and hold it to current, we get about 8.5%. So you can get away with that, but you also are going to have to, come to grips with the possibility that you could have some periods of time where the proverbial Mr. Market goes against you, like we saw during the Great Recession, which can lower your rates of return. But this is clearly a blue chip. Again, I'm going to repeat, it's not a good time to be buying this stock today. The valuation is just too high. Even if I'm looking at the normal higher PE ratio, it's trading at, its normal PE for the last 5 years has been 23. But if I look at it historically, there's been a lot of cases where it's traded at 19 and 20 times earnings. And of course, that's all changed the picture. This isn't a risky stock from the standpoint of the quality of the business, but now would be, in my opinion, a very inopportune time to be investing in the stock. Once again, if I owned it, considering its long-term dividend record, it's been a stellar dividend producer, averaging about 8% dividend growth. Now these are quarterly numbers here, just so you know, these aren't full years here. So the last full year is 2020 that I have. This has a June fiscal year, also note, as you're looking at it. It's outperformed the market in dividend income. It's tied the market in capital appreciation, and it gives it a slight edge on total rate of return over this long-term time frame. But this would have been a time where you were buying it at its fair value PE. So, it's a decent investment, and it's a great company, and it has a good dividend record, but you want to buy it when the valuation makes sense. Walmart is just such a classic valuation story. I've used it so many times. We had the irrational exuberant period where the valuation was extremely high. That led to more than 10 years of virtually no money being made at all owning Walmart, and yet that was during a period, I always want to remind people of that, when Walmart itself was performing well as a business. They were raising their dividend every year. So you've got to buy these stocks right. When the Great Recession came in, Walmart went through the recession from an operating point of view like it wasn't there. Their earnings grew, their dividend grew. Likewise, they went through the COVID situation with very, very little stress or damage to their money. And a lot of people griping about the fact that a lot of small businesses were forced to close, but yet Walmart and Target and Home Depot, which I'll get to in a minute, and some of these other companies kept their doors open. And of course, the market really ran the price up here. This is one of the highest valuations I've seen in modern times, certainly, going all the way back to 2007, you could have bought this stock at a 15 multiple. Today, you have to pay 26 times earnings. Earnings yield's only 4%. Dividend yield is about 1.5%. And again, it just simply speaks to the fact that the valuation is very high. But also note something else about the growth rate, 7% long-term. More recently, the growth has only averaged 4%. And if I even shorten the time frame, it stays around that 4%. It's forecast to grow at 7 or 8% over the next 3 to 5 years. The long-term growth rate is expected to be 7%. But the point is, that's as good as it's ever done historically, and yet it's trading at this extremely high valuation. Now, people are going to say low interest rates are driving that, and that's true. I always like to bring out the immortal Ben Graham's metaphor. In the short run, the market's a voting machine. In the long run, it's a weighing machine. The point is that people are buying the stock and running the price up, and that doesn't mean you should participate. Okay, I want to make that clear. You need to be buying stocks when they're reasonably valued, in my humble opinion. And Walmart's just a classic case of how valuation works and how it's worked historically. So that's Walmart, very expensive today. And note these stocks are getting more expensive as I go. Now, Home Depot is a little bit of an anomaly here, because if you look at this graph, and just even if I take price off of the graph and I'll take the normal PE, you can see this was a very strong grower back here with a very good dividend record. It has an excellent long-term dividend growth record, I might add. Coming into the recession of '08, which we know was stimulated by housing and so on, Home Depot did have 2 or 3 years in a row of very weak earnings growth. But then as they came out of the Great Recession, their earnings growth began to increase again. But again, they've had some spotty growth here in recent times, but a 12% grower long-term historically. I shorten the time frame. More recently, it's been an 18% grower. So when I price it at this higher growth rate, it starts to make a little more sense that the valuation has been pretty good. You could have bought this, in March of 2020, and we all know what was going on then. You could have bought it at a very attractive valuation. You could have bought it at attractive valuations in 2012. And so on. And if you go all the way back to the Great Recession, you had times to buy it at PEs of 11 and 12. And the other point of that is there are times when this stock is traded at PEs of 11 and 12 versus the 25 PE it's currently trading at. But when I look at forward earnings growth expected to be about 10% and long-term trend line about 11%, this still makes the stock expensive relative to that. This great record that it's put together, growing at 18% coming out of the Great Recession, made this a really good investment. And again, if I measure this from valuation to valuation, you'd have done very well, averaging almost 20% a year. This is what you got a little kicker here, because if you measure it today at today's level, you've got a 23% annualized rate of return. But here's the point: value investors never deny that this kind of valuation can happen. I get that all the time from people. It happens. But the point is, it's important to be aware of the risk you're taking when valuations are high like that. American Express is a moderately cyclical company, very excellent dividend record. It's BBB plus rated, has 57% debt to capital. You can see how the price responds to operating results over time. COVID came out and, the stock took a big hit on earnings. Earnings fell about 53%. The company did continue to increase their dividend, however, because it was well covered. And then they've had this enormous growth in 2021, expected at least. We don't know this number yet, but it's doing extremely well and it's expected to grow. But again, the market overshoots that. And now this would be very expensive. Buying American Express at these times when the price was in alignment with growth would have been a very attractive investment. Now, when you're looking at the amount of growth this year and then what it's going to do going forward, if it reverts back down to its intrinsic value, PE, and here I'm using a PE growth rate of 17 times earnings. If you look at the company historically, it's been a 15 multiple company. I also want you to notice that. So if I measure this at a 15-ish multiple, here's 15.6, you end up making no money on the stock over the next couple of years. Valuation matters, and it matters a lot. Finally, Coca-Cola. To me, this is exactly like Procter & Gamble. It always has commanded, or historically has commanded, a premium valuation. If I run different time frames, that normal valuation changes some. Those of you who are subscribers to FastGraph, use the tool and make sure you recognize that. But pay attention to what happens to the growth rate. We've got a company whose growth has shrunk to 3.9. Their long-term growth rate was only 5.6. The growth rate over the last decade or so has been about 2.5%. A company's forecast to grow at about 9 or 10% going forward, so there is some optimism. The long-term growth is expected to be 9%, but the point is the valuation is now PE of 27 and earnings yield of 3.7%, but a dividend yield of 2.9, but also notice that their payout ratio is getting pretty extended here at 75 and 80% for the last several years. So you want to, pay attention to that they're paying out an awful lot of their earnings to keep investors, attracted. But this, again, would not be a great time to invest in Coca-Cola, in my opinion. Anyway, that's it. That's the second, Dow. These are all extremely high-quality blue-chip stocks, creme de la creme, in my opinion, favorites of mine amongst this group, if I can buy them at attractive valuations. I hope you enjoyed the video. I hope you got a good perspective of value and understand the risk you're taking when you pay these high values. That's one of the most important messages. Thanks for watching. If you like the video, give me a like, ring the bell, subscribe to the channel if you haven't. And as always, I appreciate you, and I'll look forward to presenting part 3 tomorrow. Thanks for watching. Oh, by the way, I'd be remiss if I didn't also say, if you haven't already subscribed to FastGraphs, you might want to take a look at our free trial to FastGraphs as well. Thanks for watching.